Okay. All right. Well, let's do this. So we're going to look at, if I can pull this up on my screen. So we're going to bring up, and just unmute yourself if you have questions, because this is kind of really important right now, I think, in multifamily, taking a look at how to analyze properties. And we can get really detailed with how we look at these, and we do with our clients and commercial and multifamily. But for today's purposes, the reason I want to help people understand a little bit better idea of how to really look at these investments is because you got to be able to analyze them kind of what I call on the fly, right? Like you got to understand if someone gave you a gross rent per month, that you'd be able to come up with an idea in your head, particularly in a particular area, what would be a good investment, what wouldn't pencil out. And you should be able to do that math really fast in your head. So maybe it's 100 units and you would like to give a referral to the commercial team, but you're not quite sure if it's something you want to do. You should just you should refer it anyway. But to do the math in your head, I think it's important that we teach it today. And can we give you a couple different ways to go about it, and make it easy for you? That way you can do some of the work before the work starts, right? Because the spreadsheets and stuff that we use to analyze the data itself, I'd be doing you an injustice if I just gave you a copy of the spreadsheet. I'd be giving you just enough information to really hurt yourself with. So today we're going to go over the simple math, which I use every day, on a cocktail napkin or, a napkin, and write it down. I can tell you whether it's a good deal or not, or if it's worth looking into. And so we're going to kind of go over that, but we're going to go over the big why about why we're looking into this right now, because bring it up here. Where is it?
And do those principles, do those principles hold true regardless of the size of the property that you're looking at, whether it's like a three unit versus 100 unit?
That's a really good question. So from about 1 to 5 units don't really pencil very well.
Okay.
They because they're more conducive for owner occupancy for the money. So then you start getting into kind of residential analytics on a 4 unit, which is basically, where is it? Where is it located? So if you find a 4 unit and it's worth X number of dollars, and it's on the beach and you want to live there, that makes sense because people are going to pay you higher rent and they're going to help you with your mortgage. And all of a sudden we're into that conversation. As you get into 6 to 10 units to 20, 30, 100 units, then it becomes affordable in some cases. In other cases, they're just really expensive, and they have been. But the reason I'm teaching this class today is to keep the math simple, so you can look at them any way you want. And 2 ways I'm going to show you. But also, it's very timely right now because of what's going on in the market. So right now, we're preparing ourselves in multifamily, in commercial, for what the experts are saying is going to be a soft recession, probably anywhere from 9 to 12 months, sometime this year, so they say. And it's about 55% of the commercial real estate leaders like JP Morgan and some of the big ones say that it's likely we'll have a recession in 23. Relatively mild up until this banking issue became something. So we watch that on a daily basis. So multifamily owners are going to have to start lowering their costs to help prepare for this economic downturn. And for those multifamily owners that aren't able to do that, or maybe they purchased too high, maybe they purchased with a really short-term loan product that needs to be refinanced. Rent has kind of softened a little bit, so you're not getting the huge increases that you got in the last 2 years, 3 years. So for some of those people that are over leveraged, that let's say didn't put 50% down and have to refinance their debt, and they're really low refinance now is maybe, like probably like more like 6.5, and maybe they're at a 2. That's going to be a cash flow problem, a huge hit. So we anticipate that multifamily investors and owners that have their cash and are ready to go are going to see some opportunity for people who no longer can afford to play the game because they are over leveraged. So being able to see what we see with some of the gross income and making this kind of, why is it important we're going over this again today, is because of that very reason. I want to share with you some information that I got this morning right here. So we also know that the Fed is going to continue to be hawkish on this thing about interest rate. We don't know how far they're going to go. It's this week. Things have changed because of the banking problem. So that's kind of up in the air, but it's most likely they're at least going to leave them alone or raise 25 basis points. And so the market continues to push costs up. And I think that the recession, based on the experts that we've interviewed and we've read about, is definitely going to kind of hit. And some of the vacancy rates on these multifamilies are going to increase because people are going to lose their jobs, and they're not going to be able to afford where they're living. Some of the new apartment applications for some of the high-end stuff has taken kind of a bath. So it's not in high demand as it was just 12, say even 10 months ago. So these are all things that we keep track of, right? We keep track of trends and what we see. And we think that there's going to be multifamily opportunities this year and next. And then, of course, if there's job layoffs, we know how that affects a lot of the residential stuff, right? People are going to say, well, I need to rent versus buy. So multifamily might be something where if you get a hold of an opportunity for someone to sell because they're in trouble and people are starting to rent more, there's an opportunity for you to buy or invest if you've got the money as well. The family housing, I wrote this notes down here on my computer. I think the multifamily housing is absolutely where you want to be as an investor. The multifamily rental market will still feel the impact of the recession, like I said, but it won't feel them as badly as what we've seen in the past. The scenarios might be like, I don't know, 4.5% vacancy rate. We've been underwriting some of these at 4.5 now. So if it goes up to 5.5 to 6%, that's a different underwriting guideline for people looking at investing in multifamily. So that's really just about a 2% increase in vacancy, but significant enough if you can't lower your costs as a multifamily owner and operator. So we know that going forward, they need to streamline their operations and get their apartments recession ready. But we know that not everyone's going to be able to do that. So it's your job as an agent or broker in this business to identify the ones that look like there could be a problem. What I would suggest you do if you're looking for opportunity, I suggest you contact your lenders or even title, look at distressed properties, or find out when those refinanced products are going to need to be refinanced, when their loan products will be refinanced. And if it's coming up this year, that's something you want to keep track of. You're looking for opportunity if you're not selling as many single family homes, and that's an area where you can keep track of, and then you can get the help you need, obviously, from the commercial team here in this office for helping you along with that project, because sometimes it can be overwhelming and you want to get it right, especially for the presentation and the listing to get that to sell for sure, if we can't sell it off market. So that's really why we're talking about it today, because all these economic changes are going to create opportunity. And I wanted you, all of you, to learn how to underwrite a multifamily at a cocktail party. How to do it that fast so you think, oh, that might be an opportunity. I'll take that back to my team. I'll talk to the commercial team about it, and we'll get our help, and we'll kind of do it that way. So going forward, does that make sense to everybody? Why we're doing it today? I guess that's a yes. Okay, so
Definitely.
all right. So, yep, says Jake. Yep. So I'm gonna hold on a second here. Share screen. All right. Can everyone see that?
Yes.
If you can't see it, reach out. Okay,
Yes, I can
so
see it.
all right. So there's this, like I said, this is a cocktail napkin analytics on multifamily, because I'm going to show you, in fact, after we're done with this, I'll show you what we do for a project, for a listing, and it incorporates a lot more than just what we're looking at today. But like I said earlier, for those that weren't on the call quite at that time with Christine, was that if I gave you just a spreadsheet and to use, I really be doing you a disservice, and it'd be very dangerous for you, because you get out there and it's kind of like giving you a loaded gun and not having had any practice. You do more damage than you would do good for yourself. So this is a great way to get that same education, but quickly. Okay. So we're gonna talk about two ways to analyze property. One's a capitalization rate. Everyone hears that all the time. What's a cap rate? What's a cap rate? I get people come in my office and I got a great cap rate, and some people don't even know what the hell they're talking about. But anyway, it's a capitalization rate. It's a rate of return for your investment and the income that you get, right? So if you look at the top two above, NOI stands for, anybody know? Might as well play a game. Anybody know?
It's net operating income.
Yes. Thanks for playing. You get a star. So net operating income is everything after your expenses, but not subtracting the mortgage. Okay. If we were to do that, we'd have another analytic, which is cash on cash return, which is more of a straight up comparison to stock market and cash and return. And I don't like that one, just because it doesn't really hold any value. And most of the people that do cash on cash returns for multifamily never buy anything, because they always say, oh, I'm making 12% in the stock market. Why would I take that money out, get a cost, carry that money at a loss for 60 days, put it into something that's going to give me a 5% return? If I've got to teach someone that lesson, they're out, right? Because it just doesn't make any sense. So we look at multifamily this way to make it simple. Because, the most important, everyone's heard it before, you got to keep this stuff simple. Because if you get too complicated out of the box, it gets complicated, and then you're using vernacular and terminologies you don't know, and so it's stupid. But it's not that hard. So the net operating income divided by the rate of return, right? So your cap rate, right? Your rate of return equals the value. That's how you would decide whether the value was good, bad, or indifferent. And then you can see that you can switch the net operating income divided by the value, gives you the rate of return. So when you're looking at values, I mean, everyone on the call, just go out there and play with some numbers. Take a net operating income of 30,000 and divide it by 3%, 4%. You see what you get. When you're looking at the value, let's say the first one here, and you're looking at the value, you get a value. You have to look in the area in which that place is for sale or going to be for sale to see if that kind of rate of return is happening there. Because the rate of return you're getting in one city and one block is different than blocks two blocks northwest of that one, right? So it can be different block by block. And let me tell you, we deal with investors all the time that said, you know what? if this building were 2 blocks south and across the street, I'd give you that rate of return. But it's not. I own the ones up the street, and it's worth this. And it's kind of like boots on the ground, and you have to know who the investors are. This is kind of the next level, and then you got to know what's selling around there, just like you do for any single family home product, any townhome. You know what's selling in Bixby Village. You know what's selling in Signal Hill. What's selling? How much is it selling for? What's the per square foot averages? So you know that you're not talking to someone who's got expectations that are much higher than what you think you can deliver. And that's what we're trying to avoid here, because we're trying to avoid spending any more time with someone who's wasting our time. They want the typical Taj Mahal price for something that's, Big Bear Cabin, right? I mean, it's just different values. So if someone comes to you and says, I've got a 10 unit, 11 unit, I mean, you got to be able to do this stuff in your head, but they got a 10 unit up on Daisy. They're all studios, and I'm getting $1,200 a piece. You got to be able to calculate the gross income off of those numbers. So you would take, say they're all 1,000. So I'm getting $10,000 a month gross, right? So now I'm getting a gross return, a gross income of 10,000. Well, how do I get the net operating income off a gross number? So you want to write this number down. 25% to 30% cost, depending on the size and square footage of the building, is what you subtract from the gross income to get an estimated idea within. I mean, you're not gonna get it to the penny to get a good idea of what that net operating income looks like, right? And there's so much more to this. I mean, there's so much more. You can get into, does everyone have their own water heater? Does everyone have their own meter? Does everyone have their own electricity? There's all sorts of different values that go into what cost is really there for someone. I can tell you that if you come across what they call a syndicated deal, where you've got somebody who's raised money to buy these products, these multifamily products, I'll tell you that cost number is much higher, because the syndicators make money off fees. And so, like, if you're looking at an income expense spreadsheet on a syndicated multifamily building, line items on 10 units probably shouldn't exceed like 30 or 40 lines, right? Expenses and, income and so forth. I've seen them as big as 115, 120 line item spreadsheet for 10 units. It's outrageous. But what do I know when I look at that? I know I'm looking at expenses that are out of control, that exceed 40%, right? So there's nuances to this, and I can't teach you all in one day, but this is the start. This is what you can do with anyone, anywhere. Someone says 10,000 a month, you subtract, right? 10,000 a month. Now I'm down to 7,500. Get my rate of return, valuation. Where am I? I think I saw this particular, I remember this one for sale. That seems reasonable. I think it's a call I need to make, or I need to talk to the commercial team, get them involved. Now, the good news is that if you just had a name and a number for us, the referral fee stays the same, right? 25% doesn't matter. But if you want to get involved, let's say you wanted to handle it yourself and get that, you still need you're going to need some help. So, but you can do this. Now, again, with the NOI and the value, you get a rate of return. So the conversation is different, a little bit different, because the person you're talking to, having a cup of coffee or a glass of wine, beer, they say, yeah, oh yeah, we're thinking about 3 million, it's a good price. I know the rents are, under market value, because you start showing 3 million, and they've got a weird number for the net operating income. Wow, the rate of return on this, right? because cap rates and price have an inverse relationship, right? The lower the cap, the higher the price. Higher the cap, lower the price. If you get into somebody that's getting, even in today's market, since things have changed a little bit, someone comes to you and you figured out that they want a 2.5 cap on something, you're probably talking to somebody who doesn't have a really good understanding of what their valuations were. Because those were happening about 1.5 years ago. People were taking those to market at 2.25, 2.5 cap, right? That doesn't happen anymore. And if it does, there's some other weird reason someone bought it, you know. I know the list is long, but anyway, so that you kind of get an idea of the rate of return. What are the rate of returns in certain parts of Southern California? We're seeing 4, 4.25, 4.5% for a reasonably fair conditioned multifamily. So that's a good number to keep your eye on, 4%. So if you do some numbers and you come up with 4%, maybe there's something to look into here. And you should memorize this equation, right? I have it behind me on my board here all the time because it's something I just want to remember every day because I'm talking about this to people all the time. And it's really important because wouldn't it be nice to be in a conversation and you can underwrite it kind of right there in the moment, and all they've given you is the gross income and per unit, right? And everything's annualized. So you always multiply it times 12 and then you get the annualized net operating income. Now, this brings me to my next thing about investors. So we're talking about recession. We're talking about multifamily people and their investment streamlining costs and getting themselves ready in a cash position to make purchases. You're going to want to write these 3 things down. If they want to sell this great opportunity, which is a 12 unit with a 4 cap that is got some rents that are lower and there's some chance that someone who buys it can increase their value over time, you have to ask these people, listen, if I could sell that, what's your exit strategy? Do you want to trade your property, right? Or do you want to pay your taxes and go on your way? What is it you're looking to do? Let's say, for example, they say, well, we'd really not like to pay taxes, which is 99% of people, right? We're going to defer those taxes, the 1031 exchange, and this is really how we want to handle it. So then you got to ask them the question, which is, well, on the next property we purchase, what are the most important things in your investment? And these are the 3, right? So you got return on investment, cash flow, or your equity over time, your ROE. And the answers that they give you determine how successful you think you could be with them in finding a replacement property that makes sense. And the reason I say this is because of this reason. If someone says to you, my return on investment is the most important portion of this for me. Yeah, deferring taxes is huge, but I need to be making X number percentage off the next investment, right? Well, that'll tell you the kind of product you need to buy and identify how much of that they're going to have put down to create a return, right? And sometimes it's impossible to find the number they're looking for. So you, as a professional, with this information I have here on a cocktail napkin or a coffee napkin, could determine, based upon what you know of certain areas, if that rate of return is possible. And if you don't know stuff outside the state, that's where you start getting the commercial team involved, because we're the ones that know that information. That's what we do all day long. Data, 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 data. We're as boring as it gets, but we have a lot of information. So they give you a percentage of return they're looking for, you can't get. Well, you have to understand, maybe they understand what they want for their building, but maybe what they're looking to purchase isn't available, because if they've owned something for 20 years, if they've owned something for 5 years, the next price they're going to pay is going to be more. Well, your costs go up, right? Property taxes go up. You don't know what the next expense is going to look like on the next investment. And they may not be able to make that kind of return today. So they say, well, I want to make 6%. Well, what if I can make 6% in the third year of this property, right? What does that look like? What does an Excel spreadsheet look like there? That's a different conversation. We're out of the box. We're going to defer you, a couple $100,000 in taxes. In the second year, we're going to stabilize this thing. And by the third, fourth, and fifth year, you'll be riding on a 6% return, no problem with this particular product. You got to be able to have that conversation, and you got to show them on paper, because as sophisticated as all these multifamily people are, they're 4 years old, and they need to show on paper what it looks like. Now, the second answer to the question, or second question answer, is cash flow. Cash flow is really the most important part, Jason. That's all it means to me. So if I buy something, I want to put all of it down, and I don't want to finance more than 50, 40, 30% of the total. So we got to buy something that only can allow me to do that. Now, there's a person that you want to do business with, because they're cash flow heavy and they just want income. That person you can work with all day long, because you can find something just outside of the trade, or the trade's got to be $1 more, right? Like or kind property. You can find that. You can find it in 2 properties. And then you can show them not only the cash flow is heavy, but you probably get a little better return over time, whatever that looks like. And of course, the unspoken of what I call the 3 horsemen is the return on equity. Now, this is my favorite answer, because first of all, they never even acknowledge it. And if they've owned multifamily over a long period of time, they never give it credit. They never give it value. And quite honestly, that's just a bunch of horse crap, because over time, they've made so much money on the equity growth that it far exceeds 3 and 5% increases in single family product on a 30-year moving average, because rents create that value. So they never give you that. But if the wise man says equity growth is important to me, that's important for you to know too, because they're acknowledging that the equity growth is important, and maybe they're willing to spend a little bit more for a place that's got a little bit better geolocation for equity growth over time. Because we all know, right, that certain places grow faster than others. So you have to be able to digest all this. And I know I'm giving you a lot of information, and I know it may be overwhelming, but this is our passion. This is what we do, and we're always available to help you understand product knowledge better. And then the fourth thing I'll tell you about the answers to these 3 questions that you're asking them about their sale of their property, what they're looking to trade, is if someone says, I want all 3, you're probably dealing with Mr. or Mrs. Impossibility. Because I rarely have seen, unless it's been a sale at the courthouse steps, or someone's just signing over paper, where you get all 3 of those in a 24-month period of time. You never get all 3. You start off with the most important. Cash flow is the most important to me as an investor, and equity growth for me is good, really important. So location for me and cash flow. And then I know at some point my investment will pay off. As long as I'm getting cash flow per month, I'm good. But that's me. Some investors are different. So all of those questions are designed to give you an idea of your little equation here that I have on the paper about value, rate of return, and net operating income. So that's the first. This is the first part. Do I have any questions or concerns, or should we stop here and do this next month for the second half? Anything?
Jason, you spoke at a high level with regards to the numbers. Could you give an example where you're actually walking through what are the differences for what the numbers would look like.
Sure. Look here on my board. I got one new one. Okay. So take a number of 72,800 divided by 1,693,000, 1.693, right? 1,693,000. And tell me what number pops up on your screen on your calculator.
Or 0.3%.
There you go. There's a real working valuation we're doing right now. The net operating income is 72,800, and the valuation was 1,693. That's a 4.3 cap. Now take the 72.8 divided by 4.3%, and you should get 1.69.
Yep.
Right. So if someone was looking for a higher cap or a lower price, you just divide it by 5%. That number of 72.8. Divide it by 5%, and you'll get a lower number on the valuation. And it's such a simple equation. And hopefully sharing it with you, you'll go around and play with it a little bit, or write it on your notes, or have it in your desk, and you'll play with it every once in a while, or get on the MLS and go look at multifamilies and punch in some valuations and see what you get. Most of the listings that I see from I would just say residential agents doing multifamily, they don't have a lot of experience. Most of the time, the net operating incomes that I see in the MLS are wrong, right? Most of the data is inaccurate. So just always be aware that the inaccuracy of what you're seeing may lead you down a rabbit hole that you're like, wait a minute, this doesn't seem right. Sometimes they'll give you an annualized number of gross rental income that is too small for one reason or another. It's the nature of the game. We all know that, right? And we all know that, it's only as good as the person putting the information in. And who knows?
I have a question about this.
Yeah.
I've seen that, or I've heard that a good or a cap rate that people normally want to shoot for is like over 5, maybe even up to 10%. And I know that's like a lot, but the 4% ish that you're talking about, is that because it's California and the values here?
So the cap rates in California are lower than most places.
Okay, I figured. Just wanted to ask.
Yeah. So and truly, depending on kind of submarket to submarket, they really vary a lot.
Yeah.
But yes.
Okay.
Any other questions?
And do you often see the cap rates being much lower for multifamily as opposed to commercial properties? Just because of the cost of the value of properties here being so much higher than what the potential
Overall,
are.
as an average, yes. But would you like the buts? I love buts. So, but in an area where we have supply demand issues like industrial, I can push my cap rates down to 4 on industrial land right now in like Santa Fe Springs for an area, because it's highly sought after. It's got like 700 different freeway entrances. It's got rail yards. It's got, all the great stuff. So I can push it because there's nothing else available. But normally, yes, cap rates on investment industrial, yes. Multifamily is a special, multifamily is just really special, right? Because it's, people live there and rents have become, you know, people say rent control. I mean, how many of you have a negative outlook on rent control? Does anyone have a positive look on rent control?
Well, I had a negative outlook on rent control before this weekend, and then I had a conversation with the client and we dug into it. And then all of a sudden I learned a lot about it because I didn't understand how it worked.
Okay. So, and that's exactly what happened. So I look at a rent control and I say to the owner of someone who hasn't increased their rents over a long period of time, there's a couple stumbling blocks there. But rent control allows you to increase your rents every year, period. And in across the board, everybody's doing it. So you're just going to be able to increase your rent, and that's it. Now, if you don't do it and haven't done it, and you have a large gap to make up, yeah, that's a kind of a problem with certain tenants. But rent control allows multifamily to continue increasing rents regardless of what's going on, with all the CPI limitations and what, I don't know, it's 5 plus whatever it is. I mean, right now I think that, you know, CPI is over 10. You can't, people aren't going to pay 15%, but some people, you know, they do. But multifamily is a real special product. Multifamily performs like an oversized steroid-ridden home when it comes to escrows. So it's never that complicated, yet it is complicated. A lot of egos involved in this multifamily world of brokers and people who think they're better than everybody else. I'll tell you, keep it simple, pretend like you're 4-year-old, and you can make a lot of money on these. A lot of money and good opportunities if you're looking. So I'm going to move on to something that's going to make it even easier to do what we just went through on the valuation. But like I told you, I like buts. But this is a little bit more about data trending as an analytic screening for the actual unit itself. And let me just show you how that works. So the gross rent multiplier is equal to the fair market value of the divided by the gross rental income. So the number that I gave you at 72.8 on this equation was the net operating income, because we subtracted the costs, right? Operating expenses. This will just allow you to say, you know, it's $100,000 in gross income and the fair market value is X. And in this particular equation, 8.3 gross rent multiplier in this example I'm giving you, right? Interesting, because a lot of the GRMs that we see in multifamily, let's say in the submarket of Long Beach, in Belmont Heights, right now we're really getting down to the nitty gritty, very block to block. I mean, it's worse than the cap rates, right? I mean, it's incredible. And those numbers for people that are buying that only use gross rent multipliers as a valuation tool like to see the number at 15 or below. Historically, people talk about, you know, examples I've seen where they want a gross rent multiplier of 5 or 7. In California, it doesn't exist. They're too expensive. Because ultimately, the gross rent multiplier is an indicator of how many years it would take you to pay off that debt and estimation. But if someone said I had a multifamily and it's worth 200,000, all you need to do is get the gross income and you're good to go. Or you can do, you know, the other way with knowing the typical GRM for the area. You can do it the other way. It's, you know, it's reversible. And that's an easier way to do it. But if someone says, again, looking for something under 10 for a GRM for a multifamily producing investment, you're probably not dealing with somebody who's bought a lot in California lately, or has, just maybe isn't really realistic about what they're looking for. And really, this whole thing today is about identifying the fact that we're in a changing environment. I know Keller Williams loves the word shift. I'm about over the word shift. So I really like the word, we're in an environment that's different than it was last week. And that's really true. I mean, with the banks and everything, investments, I mean, that was the last thing we thought we'd see. So this is an opportunity for you to identify and ask questions to people who have these investments and how how banking affected them, or if they're going to be refinancing, ask those questions. Because we know, in, like, for example, in office investment buildings, those are just they're gonna crumble. I don't even know how that's gonna all work. Stay tuned, watch the news, because if you have an office building today and you've got $65 million in debt and you got to refinance that right now, you may just be walking away. In lieu of foreclosure, here's my keys. And the bank doesn't want it. You think a bank like SVP B wants their office building back? Nope. Right? And USB just bought Credit Suisse. What does their portfolio look like in lending for commercial product? No one knows yet. So there's going to be opportunity here. What I'll tell you is if based upon this information that you have today, you can make decisions on product that you're looking at, opportunities to talk to people, and get a little better understanding of where people are. And that's really the education you need to go out and talk to people about their investments. There's really nothing else that you need, because I'm going to show you another screen in a second, and this one is the one that, when it gets really down to the nitty gritty and we're doing a listing presentation, this is one of the pages of our broker agent opinion of value. This is what they see. And that would take, for me to explain the entire spreadsheet, would probably take, a 3 or 4 hour class just to get you rolling. But we have your back. And I think that, one of the things we've done in this office really well, and credit to leadership, is that they've created an environment where you can come, take your hard cases, come in the door, figure a way out, make money, and learn a little something while you're here. That's a win-win for me. It should be a win-win for you. And it doesn't happen like that everywhere. I've been a lot of places and it doesn't happen like that. And I know that some of this stuff can be very, very overwhelming, and that's just the way that it sounds, but we can help you. And you need to make this part of your portfolio of business going forward in the next 24 months, some sort of commercial flavor in your real estate Sunday, right? It's got to have a little of that in there. Don't give up on your residential, but have a little bit of it in there, and don't be afraid about something being too much for you. It's not too much for us. We've got your back, but you need to be able to identify it and feel like you can take care of it. And you can say, our commercial team, which I'm a part of, you can tell them that, and just say, we can get this done for you. And let's set up a time to talk. Right? That's the most important part. So let's see here. I'm going to share something new, I think. So I'm going to stop sharing this one. Stop sharing that. And I'm going to share. One second. Oop. One second. Where is it? No, where is it? One second, I'll get there. Almost there. Okay, almost there. Now I can share again. And it should, where is it? It's not there. No, no. Well, I'm trying to share this and I'm sorry that I'm having trouble. Let me, why won't that open? I don't know. Sorry to keep you all waiting, but I want to just show this to you. I think it's really important. Hopefully you'll wait.
If you need to, you can email it to me and I could try to share it.
Oh, would you?
Mm-hmm.
You're the best. Oh, I know why. Well, I know why, but I'll let you share it because I have too many screens open and too many paste front. Okay, there you go. It'll just be a second here. Does anyone have any questions right now of what we went over already?
No, that'll make sense.
Well, it sure is fun to have opportunity. And I think if you're not overwhelmed by a few ideas of how to look at it. All right. Can everyone see that?
Can everyone see?
Yes.
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 So this is one of our opportunities that we've had in the past. And this is how the analytics look. And it takes into account all the things we were talking about, but gets into detail. Talks about market rents, which we call the pro formas, talks in terms of costs, lending costs, per square foot analytics, on and on and on and on and on. But when we present information to our clients, this is the kind of thing that we're presenting as one of the pages of our valuations, especially if we're trying to get the business. And this kind of takes into account sometimes the construction costs on a carry basis that a lot of these guys and gals have. And it addresses that, which is kind of a advanced look, but at least it acknowledges that it knows, it shows that we know what we're doing. And it helps them analyze, and then investors too. The investor sees this and says, oh, yes, this makes sense to me. I'd put, if you look at the top, it says down payment, I'd put 60% down. So these numbers get really good. So just give you an idea. Now, the one thing, can you scroll down a little bit? Sophia, yeah, thank you. If you'll see down at the bottom in the scheduled income, there's the monthly income. And do you see the difference between the monthly on the current and monthly on the market, there's a big difference. In fact, the scheduled gross income at the total at the bottom, right? Now it's 168,000 a year, 169, versus what it should be was 243,000 a year. Now that's an indication of someone who has had rents low for a long time and needs to bump them up and doesn't want to and just wants to sell the property at this price. And this would give you an increase in value over time, which would meet back to that conversation we had about equity growth, right? And investment return. So that's what.
Question about rent control.
Yeah.
Where could I find something online that shows that you can raise the rents every year, or just some of the rules about that? Like, where could I find resources for that?
So either Orange County or the LA Apartment Association.
Oh,
It's a great resource of everything multifamily.
so I could just Google LA County Apartment Association.
Yeah, you'll see it. LA Apartment Association. There's a couple. I mean, I can't remember the acronym for the URL, but Orange County Association of Apartment.
Yeah, that's fine. I'll find it.
Yeah, it's a great resource for everything. If you ever get a rental, you should join it.
Okay, yeah, that's really cool. Thank you.
Yeah. Okay, so we've got 5 minutes left. So kind of want to review where we've been, where we started and where we ended, right?
Do you want me to stop sharing?
You can stop sharing, yeah. Thank you. Thank you, Sophia. Appreciate that. So reason for today, and the reason I brought this up was because opportunity is coming in relationship to recessionary times, higher vacancies, and we think that some people are going to be underwater, to create an opportunity for investors or for yourself or everyone. It won't be, I don't think it's going to be a tremendous, flood of events, but it's changing. And if it hadn't changed, things would just kind of go down their path and people would not talk. I mean, last couple of days, I've had more conversations about banking than I've ever had in my entire life, right? Where do you put your money? Or, how do you do this? Do you do that? Oh, I opened up an account over at Farmers and Merchants just last week. We had our payroll. We do our payroll here. People didn't talk about that a week ago. So as things change, the conversations create themselves. And as agents and brokers in this business, we're always looking for a reason to talk to them about it, or at least ask really intelligent questions. Well, this is a great time for that. So you've got some information about why we're doing it. You've got information about how to analyze it on a cocktail napkin, right? I mean, I should patent that. Cocktail multifamily analytics, right? And you've got an understanding of it gets real complicated real quick. So don't step in too far without some help. Whether it's from us at the commercial team, from the broker, from whoever that's got a good hold of this information and understands it and can lead you down the path, because you only get one shot, right? You get in front of somebody and you're going to pitch your wares, you better have it right. And in this business, you better have it right, or they'll know right away that you misvaluated, or you don't know what you're doing, or you're colorblind, or whatever happens in that moment. And anyway, I was excited to share this today. Anybody have any questions, concerns, or anybody got a referral?
I was just thinking that instead of a cocktail napkin, you got to create your own business card that actually has the questions to ask on one side and then the calculations on the other side. And people have that in their business card holder along with their own cards.
Awesome. Great idea.
I just heard opportunity when you were talking about this banking situation and this, my ears just heard dollar signs.
Yeah, I mean that's the idea, because I've been in this business a long time and I've seen weird stuff, bad stuff, good stuff, whatever, economic downturns, and there's always money to be made. You just have to be educating yourself every day, really read some really good sources of information, stay off the main news, and hit, if you want something good to read in commercial real estate, read globestreet.com. It's a great source of information. It's got current articles, what's going on in every sector, from industrial, multifamily, office. It's a great source. But
What was that again?
Globe Street.
Globe Street. Okay.
LOBEST.com. And keep yourself educated and be thirsty for the knowledge. But stay away from the mainstream media bullshit. Go with the stuff that has, really good information about what's actually happening. And just educate yourself every day, and then ask lots of questions. And I think that's it. That's all I got. I think this is really powerful information, and go grab a cocktail tonight, write your equation on there and share it with somebody. Show them how bitching you are. I'm giving you permission, as graduating from today's class, to grab a martini, a pen, and a cocktail napkin and go after it.
Thanks
That's
for
it.
sharing.
Really good.
Awesome. No questions. We're all done.